Imagine walking through a supermarket where almost every product costs less each month. Consumers celebrate cheaper prices, yet businesses quietly struggle because continuously falling prices threaten their survival and future growth. At first glance, cheaper products sound like wonderful news. Families save money, everyday necessities become affordable, and purchasing power appears stronger than ever before across the entire economy for consumers. But what if lower prices never stop falling? What happens when businesses earn less revenue every year, workers receive smaller salaries, and investors lose confidence in future economic opportunities? This is the dangerous economic condition known as deflation. Unlike inflation, where prices continually rise, deflation causes goods, services, wages, and assets to become progressively cheaper over extended periods of time. Many people assume deflation benefits everyone because consumers pay lower prices. However, economists often fear persistent deflation more than moderate inflation because it slowly weakens economic activity throughout an entire nation. China, the world's second-largest economy, has recently experienced mounting concerns about prolonged deflation. Falling producer prices, weak consumer demand, and slowing economic growth have raised difficult questions about its economic future. To understand why economists worry, we must first understand why healthy economies generally require modest inflation instead of constantly falling prices, despite what everyday consumers naturally prefer while shopping regularly. Inflation sounds unpleasant because higher prices reduce purchasing power. Yet moderate inflation encourages spending, investing, borrowing, and business expansion instead of delaying economic activity indefinitely across society and financial markets. Imagine planning to purchase a new smartphone today. If you know the price will remain stable or increase slightly next month, buying now seems perfectly reasonable and financially sensible. Now imagine expecting that same smartphone to become significantly cheaper every month. Instead of purchasing immediately, you wait. Millions of similar decisions gradually reduce business sales across the entire economy together. Consumers delay purchases because tomorrow promises lower prices than today. Businesses receive fewer customers, lower revenues, shrinking profits, and increasingly difficult financial conditions, despite offering attractive products at competitive prices continuously. As consumer spending declines, companies reduce production because warehouses fill with unsold inventory. Factories slow operations, investment decreases, and employers become reluctant to hire additional workers or increase wages anymore. Eventually, businesses facing weaker demand begin reducing employee hours, postponing expansion plans, and laying off workers entirely. Lower household incomes further reduce spending, creating a dangerous self-reinforcing economic cycle over time. Economists describe this phenomenon as a deflationary spiral. Falling prices reduce spending. Weaker spending lowers business revenues. Declining revenues eliminate jobs, and unemployment further suppresses consumer demand across the economy. China's current situation illustrates why this cycle concerns policymakers worldwide. For decades, rapid industrial growth transformed China into the world's manufacturing powerhouse through investment, exports, and remarkable productivity improvements consistently. Factories expanded rapidly across countless industries, producing electronics, clothing, machinery, furniture, appliances, and countless consumer products exported worldwide. Manufacturing became the foundation supporting China's extraordinary economic transformation over several decades. Massive investments built industrial capacity capable of producing enormous quantities of goods. High-speed railways, ports, highways, factories, and modern cities reflected extraordinary confidence in China's continued long-term economic expansion and prosperity. For many years, this strategy succeeded remarkably well. Rising exports, strong investment, urbanization, and expanding global trade generated rapid economic growth while lifting hundreds of millions from poverty into middle-class lifestyles. However, economic success gradually created new challenges. Factories became capable of producing far more goods than consumers, both domestically and internationally, could consistently purchase at profitable prices over time. When supply grows faster than demand, competition intensifies dramatically. Manufacturers reduce prices simply to maintain sales, sacrificing profit margins while attempting to keep production lines operating and workers employed successfully. Initially, lower prices attract more customers. Eventually, however, businesses discover demand cannot absorb unlimited production regardless of discounts, promotions, or aggressive pricing strategies aimed at increasing market share continuously. China's property sector added another layer of complexity. For years, real estate development drove investment, employment, household wealth, and local government revenues throughout many regions of the country simultaneously. Developers constructed enormous numbers of apartments, expecting strong future demand. As housing markets weakened, property values declined, construction slowed, and confidence among consumers, investors, and financial institutions deteriorated significantly. Households feeling less wealthy often reduced discretionary spending. Instead of purchasing vehicles, electronics, vacations, or luxury goods, families prioritize saving money against uncertain financial conditions and declining asset values instead. Businesses observing weaker consumer demand become increasingly cautious. Expansion projects pause, hiring slows, equipment purchases decline, and entrepreneurs postpone investment decisions until economic conditions become more predictable and profitable again. Exports have historically helped offset weaker domestic demand. However, slowing global economic growth means foreign customers also purchase fewer manufactured goods, reducing another important source of income for Chinese producers today. As exports weaken and domestic consumption slows simultaneously, manufacturers face growing pressure. Excess inventory accumulates while factories compete aggressively through lower prices rather than stronger demand or expanding international markets. Producer prices often fall before consumer prices because manufacturers reduce wholesale prices first. Persistent declines suggest companies struggle to maintain profitability despite continuing production and intense competition across numerous industrial sectors nationwide. Lower corporate profits reduce available funds for research, innovation, technology upgrades, employee training, and business expansion. Economic dynamism gradually weakens as financial resources become increasingly constrained by shrinking revenues and margins. Banks also become more cautious during prolonged deflationary periods. Businesses borrow less because future profits appear uncertain, while lenders worry borrowers may struggle repaying loans amid slowing economic conditions. Debt becomes especially problematic during deflation because incomes decline while loan obligations remain unchanged. Repaying fixed debts becomes increasingly difficult as businesses and households earn less money over time steadily. Governments often respond through stimulus spending, infrastructure investment, lower interest rates, tax reductions, or financial support designed to encourage borrowing, spending, investment, and renewed confidence across the broader economy successfully. China has implemented various measures supporting growth, encouraging consumption, stabilizing property markets, and assisting businesses. Policymakers continue searching for effective strategies, balancing long-term reforms with immediate economic stabilization objectives carefully. Some economists believe expanding household consumption offers the most sustainable solution. Stronger domestic demand could reduce dependence upon exports and absorb greater portions of China's impressive manufacturing capacity over future decades. Others argue structural reforms remain essential. Improving productivity, encouraging innovation, strengthening private businesses, and increasing consumer confidence may ultimately provide more durable economic growth than temporary stimulus measures alone. Despite current challenges, China's economy remains among the world's largest, most diversified, and technologically advanced. It continues investing heavily in renewable energy, artificial intelligence, advanced manufacturing, and high-value industrial development strategically. History demonstrates that major economies frequently experience difficult transitions after long periods of extraordinary growth. New economic realities require adapting policies, institutions, and business models to changing domestic and international conditions successfully. The greatest danger lies not in lower prices themselves, but in expectations. Once consumers and businesses believe prices will continue falling indefinitely, spending slows, investment weakens, and economic recovery becomes increasingly difficult. Confidence remains one of every economy's most valuable assets. Businesses invest because they expect future demand, consumers spend because they trust future incomes, and financial markets depend upon optimism about long-term growth. When confidence weakens, even productive economies struggle generating sustainable momentum. Factories remain capable of producing goods, yet insufficient demand prevents businesses from realizing their full economic potential successfully over time. The so-called China trap illustrates an important lesson extending far beyond one country. Economic prosperity depends not only upon producing efficiently, but also upon maintaining balanced relationships between production, consumption, investment, and confidence. An economy cannot thrive forever simply by making goods cheaper. Lasting prosperity requires profitable businesses, confident consumers, productive workers, responsible governments, and sustainable demand supporting continuous innovation and long-term economic development. Ultimately, the real challenge is not whether products become cheaper. It is whether businesses, workers, investors, and consumers continue believing tomorrow offers greater opportunity than today, despite temporary economic uncertainty.